Back with us on Halftime Report, and EPACK Durables is the next management on the show. It was a weak set of earnings for the fourth quarter. Revenue and net profit declined more than 16%, while EBITDA margins were a healthy picture there. There was also a reduction in working capital days from 91 in FY23 to 45 days in FY24. We'll discuss all of that and more. We have Mr. Ajay DD Singhania, the MD and CEO of EPACK Durables, joining in. Mr. Singhania, good afternoon. Thanks a lot for joining in. How is the demand picture shaping up, Mr. Singhania? Because you mentioned that revenue declines during the quarter was because of the weather disruptions and also some of your clients shifting their manufacturing in-house. How is demand shaping up, especially because the summer that we have had? What's the situation on ground right now?
See, right now, we are in an exceptional season for the cooling products because the severe heat, especially in the north of India. So we are currently experiencing a situation wherein from the brand side, if we look at the market is in a stock out situation mostly. So we are experiencing almost 50% plus growth in this quarter.
Right. And what about the margins? Do we see improvement there? What's the target that you have for this year?
See, definitely, yes, margin improvement we will see on two counts. One being that obviously we had done a lot of backward integration in the previous 2 years. So that backward integration definitely had played a significant role in our improvement in the operating margin and EBITDA for the financial year ended 24. So currently also we definitely are looking at leveraging the infrastructure what we have set up, and also the additional capacities what we have put up by adding a new plant in South is definitely helping us leverage the extended season and the increase in quantity what we are seeing.
Any plans on expanding capacity? You just mentioned about a new plant that you added in the South. Are you looking at more geographies and adding more plants in the year?
So currently, there's no plan, although we did a fundraise at the IPO in January itself, so that money is still parked in the bank as a fixed deposit. So for the next 12 to 18 months, definitely there is no plan for any significant improvement or enhancing capacities, especially for AC. Having said that, we are definitely looking at diversifying some of our products. So we are adding newer products in this current year. So we are going to add washing machines by September, October, and then other products in the small appliances as well, small domestic appliances. So that sort of diversification we are doing to utilize the existing capacities during the lean season of air conditioning. But no significant enhancement capacities for AC definitely.
I wanted two important data points from you. One was the kind of capacity utilization that you're currently at. You said that you will be leveraging on your assets that you have. So what is your targeted capacity utilization by the end of this year? And the second one, working capital days. There's been tremendous discipline. 91 days have come down to 45 days. Is there scope for further reduction? If yes, what's the target?
See, first for the working capital days, definitely we had worked on all the key levers, both the inventory corrections and the debtors and the creditors. So inventory correction is the further lever we look at where there is definitely scope to improve further. So there's a lot of dependence on import currently. So especially March being the peak month looking forward, April maybe definitely have to carry certain amount of inventories, especially the imports. So that's something we are working on. And going forward, as we are looking at the localization of a lot of imports getting localized in next 1 year and so. So there's a lot of improvement possible in further reducing the working capital. So ideally, we are looking at further improving it in the current financial year.
You have a ballpark number for that from 45 days? Do you plan on bringing it down to say 40, 35? What's your target for that?
35 would be an ideal target to look at under the current circumstances.
Right. So on the debt front as well, you've managed to deleverage your balance sheet considerably. Your debt to equity has come down from 1.58 to almost 0.37. As of now, you still mentioned that your proceeds from the IPO are still unutilized. Do you plan on utilizing some of those funds to further bring this debt to equity down, become a debt-free company on the balance sheet front? Or do you plan on utilizing those proceeds for other purposes?
See, other purposes definitely are under evaluation. So we are looking at both organic and inorganic opportunities to utilize the funds. For debt repayment, we already used 80 crores from the IPO proceeds to repay that. So now we don't have any significant loan. It's probably close to 90 odd crores is the only term loan what we have besides the working capital. So we don't have any significant loan to pay off as of now.
You entered the air cooler category in the fourth quarter, and you mentioned as well that you're looking to diversify away from non-ACs. Diversify away from ACs into non-ACs. So what's your, ideal mix going forward? What's your current contribution from air conditioners? What's the target for FY25 and then eventually beyond?
Yeah. See, currently our revenue mix is 80% from air conditions and almost 20% from non-air conditions. Going forward, these we call the large appliances and large non-AC appliances, what we're adding like the coolers and washing machines. Definitely, this being the first year will be the ramp-up period for us. For FY26, if we talk about, we are definitely targeting to bringing it down dependence on AC from 80 to 70 odd percent.
80 to 70%. And does that have a bearing on your margins? Because large appliances, I presume, would do a lot better for your EBITDA, right?
Definitely, yes, definitely. That's the target now. Like I shared earlier, a lot of it is because of our in-house manufacturing. Our own in-house manufacturing today contributes almost 65% of our total value add. So that's one significant thing which we are going to leverage further.
How much better can the EBITDA get? I mean, what's the delta? If, say, for instance, the contribution of non-ACs increases by 10%, how much does that improve your EBITDA?
See, our current EBITDA for FY24, we reached almost 8 odd percent, 8.2% is what we have already achieved. So maintaining it around 8 would be the target for the short term for next 1-2 years. And then further improving it would definitely be the long-term target. So currently maintaining it at 8%, around 8% is what ideally the target is for us for next 2 years. Because we'll be newer products, yeah. So there will be some
long-term. And you said long-term there is a target for improvement. How much is that? Is that 8.5%, 9%, closer to double digits?
I think that would be too forward-looking, but yes, definitely currently maintaining at 8% because newer categories getting into, there is a certain amount of entry cost what needs to be paid to the market.
One final question then. You mentioned that you have acquired new customers and increasing your wallet share with other existing customers as well. But now that most of your major air conditioner brands have shifted their manufacturing in-house, say the likes of Voltas, Daikin, is your focus going to shift towards the newer customers that you have acquired going forward?
See, first of all, the existing larger brands, they have not got into manufacturing for the first time. So it's an extension of their current manufacturing facilities. So they have enhanced capacities, but at the same time, even in the current quarter, we are experiencing that their enhanced capacities are also not sufficient to meet the market requirements. So there is a huge pent-up demand, and this increase in demand is going to continue because India currently is at a very low penetration for AC. So AC market is definitely going to increase forward by 12 to 15% year on year for next 8 to 10 years. So we will continue growing with our existing customers, even though they are setting up their own capacities, and definitely acquiring new customers is an add-on for us.
All right, Mr. Singhania, we'll leave it at that. Thanks a lot for joining in, sharing your outlook for FY25. That was the management of EPACK Durables there, sharing their outlook for the road ahead. Let's slip into a short break. Now we'll get you more on the markets and stocks on the other side as well. We'll put the spotlight on stocks like Welspun Corp, Bharat Dynamics, IPCA Labs, all of them who are reacting to their fourth quarter numbers. Stay tuned, back on the other side.